about it in the public arena forever.
All right.
Oh,
should I start?
Yeah.
Okay. At CFA Boston, we have a few conferences. On December 16th is climate data and portfolio scenario analysis. January 14th is tech talk, conversation with advisors about critical and current tech trends. January 22nd is virtual class, data visualization, business analytics with Microsoft Power BI. And then January 27th is career chat, endowments and foundations. So do you have anything to talk about at Quant University, Shri?
Yeah, so tomorrow we have a explainable AI workshop with Ian Code from the University of Washington. So he and Scott Lundberg, who basically is known for his Sharp value in the explainable AI world, they're going to be doing a workshop on how do you look at the whole unified explanation of machine learning models. So it's between 11:30 to 1, if anybody is interested. So Hugh, I think I sent out like a brief, so if anybody's interested, you can share it.
I just sent that out to the QWAFAFEW mailing list.
Okay, and it's a free workshop. Anybody wants to sign up?
Yeah.
I just wanted to figure out, like, did you say Microsoft Power BI on January 22nd?
I think that's what it is.
Okay.
Yeah. And I haven't read the description for the talk.
Okay.
So are there any other announcements? Okay. Emilian Belev is led the research and development of Northfield's enterprise risk at Northfield for about 2 decades. He is responsible for the integrated framework of multi-class analysis. The range of modeled assets under his responsibility include fixed income, equity, fixed income, currency, interest rate, credit derivatives, structured products, and directly owned real estate, private equity, and infrastructure. He has introduced innovative methodologies in the area of convertible bond analysis, pricing path dependency, credit risk analysis, and optimal investing in infrastructure and commercial real estate and private equity. Emilian has presented at some of the topics at industry events and published research in peer-reviewed journals and book chapters. So with that, I'll let you take it away.
Thank you.
So,
Thank you.
I'm going to make you the host, and you can share your screen now.
All right, just 1 second. Let me open. Is anybody seeing my screen or not yet?
Not yet.
Okay. One more try. Okay, here we go. Is it visible now?
Yes.
Okay, cool. So thank you for gathering today to hear the talk. It's an interesting subject since it represents 2 kind of very diagonally opposing challenges in the industry. One is being a tradition of very simplistic treatment in terms of the financial econometric techniques that are used. It has a lot to do with the way those investments are made. And the name of private is clearly giving that impression. And the other is kind of almost part of the same challenge, is that when we have these investments, there's very little data, and there's very few things that we can do with the traditional techniques that we are used to using on the public asset space. So the kind of the word quant is really heard in the private equity space and pretty much anywhere in the private asset space, but particularly in private equity and venture capital, since it's just not something that people trust. It's just that not that many people working in this area. I happen to know very well 3 of those people, and they're probably a good percentage of the people that are very well, could be very well referred to as quants. What we usually do in our world. So the purpose of a lot of the work that we've been doing lately, and this presentation is just an extension, one of the sort of tentacles of application, if you will, of some analytics that we've been doing and research thereof, is really the topic of benchmarking private equity. So while we've employed some of the technology and models that we normally do in our firm, I think the discussion is thought provoking and addresses issues that are pretty broad and general. So anybody can try and tackle those issues, or at least try to find answers to questions that have been raised. That being said, and kind of narrowing down on the benchmarking issue, is how and why are we really benchmarking? And I found that over the 20 plus years I've been working with Northfield, asking people how do you benchmark, how do you choose your benchmark with, say, public equity managers or fixed income managers, they immediately have an answer. They can recognize whether the benchmark is appropriate or not, but they can pretty quickly, within a matter of minutes, summarize if they feel that the benchmark is not perfect, what are the reasons for it, what are the constraints that they have to follow that particular benchmark. And when we do the same thing on the private asset side, it's really much more kind of undefined. Everybody's talking about different types of analytical frameworks, how they benchmark private equity. In other words, how do they measure the performance of the asset class or particular investments to identify whether they're superior to their peer group? That's essentially what benchmarking is. And over the years, I've come to kind of aggregate these in 4 broad groups. First of all, we've seen clearly on one side of the equation, we always have a private investment. That might be a portfolio or individual investment. Normally, that would be a fund, like a limited partnership agreement. And why not some of those SPACs that emerged as of late, even though kind of they are much more peculiar in the way that they're publicly traded. And there might be a portfolio of LPAs on the kind of what we measure if it's a superior investment. And on the other side, that's really where things varies, whether we're using a private or a public benchmark to measure the returns on a private investment. So these are generally the 2 broad categories. And there's a third one, actually, which I think is normally considered an exercise of liability, asset liability management. But since it has such a discrepancy in the application with private assets, and we'll get to that, I'd consider it more of a benchmark question rather than just something that resides with ALM people. At least not with the tool set that they've been dealing for a long time. Somewhere in the middle is the PME style benchmarking, which is essentially kind of a more peculiar, ingenious way to measure the performance of a private investment compared to a public investment. That's the general idea of the PME style benchmark. we'll go over these and kind of bring out all the issues that they represent in the current application, that at least in our experience, which has been very dedicated in the way of trying to find out what people actually do and trying to make it better. But certainly the first part has taught us a lot, and we've been speaking with pretty much all the different vendors of such data, know kind of the nature of the data gathering process, the limitations that it brings along with it, as well as what their clients normally would consider to be constructing a benchmark. So all of these different, experiences and reflections on our own thinking about it sort of blend into this presentation, and certainly the time that we have is not enough to discuss all the different nuances, but at least at the kind of high level, we hope that you'll get a sense of what these things are and how they can be improved. And we can certainly take this offline if you have any other ideas or other experience. So let's talk about the first one. It's probably the most common one, I would say, or at least 50-50 with the private versus public. Its major attraction is that is actually a drawback. The returns of private investments, private funds, do get reported by managers, and since those are not unlike mutual funds or other publicly traded vehicles that, or at least have instruments underneath that are publicly traded instruments, the NAVs of those are not arm's length prices. Those are subjective, accounting-based, judgment-based prices that are subject to a lot of different biases and motivations. Clearly, if somebody is able to report performance that benefits them, it's hard to imagine that they at least wouldn't cut some corners to do that. That's exactly what's happening with those returns. The issue is that just like you might have seen real estate index returns, which are appraisal-based, they're very smooth. In other words, if you're returning one quarter, it's going to be quite similar to the return in the previous quarter. They exhibit very low volatility, and that will sort of kind of make the whole exercise of measuring return moot, because you don't have an actual sense of what this investment is worth. But if we're considering we're measuring apples to apples, we would still be measuring returns that have relatively similar level of volatility, and even if it's smoothed, and you can clearly say, yeah, they're both impaired by this kind of bias and subjectivity of the reported returns, but at least it's on both sides, so we can take the bias away, and we can compare things. That's kind of the idea behind it. So we can, the way I've seen this done is just filtering a universe of funds that at least resemble in strategy and vintage the fund that they're looking at, or the portfolio characteristics that we're looking at, and take the weighted average of returns over time and compare those against the returns of our fund. The idea, though, is, and I'm a little bit oversimplifying, that normally a benchmark, at least on the kind of rigorous public market asset space, a benchmark would be a minimum variance portfolio. In other words, we are making sure that we have an efficient portfolio that is, we're not taking any risk that we're not getting paid for, and that's the idea of an efficient portfolio, and that would be the benchmark, because we don't have any superior knowledge, and the very concept of active risk is really a reference to that efficiency. So we're saying that we either have efficiency and we invest in that, or we actually believe that it doesn't work always, that we measure against it, but we should know how much active risk we're taking. So unless we have that reference of like the minimum variance portfolio, which has zero inefficient risk, so to speak, we can't measure how much of that inefficient risk we're taking in order to gain some of our superior insights or skill to gain superior returns. That's how the concept goes. However, when we're talking about minimum variance in the private asset space, it's really much more difficult to accomplish the same things. We don't have data. I mean, we don't have so many points, and those are smoothed, as we said, and the correlations will be just both. They're close to zero or very high, depending on like whether using different strategies or different asset classes. I've seen both, but there's nothing kind of in the middle. Any minimum variance portfolio you get is prone to be just deficient. It's going to be just a spurious construct. We don't have that. So our approach will be different. First of all, let's think about what is really the value of a private investment. Is it just like a public investment that we're holding, and there's always that characteristic that we can sell it in the marketplace? It's just designed to be like that because it has that inherent quality of liquidity that we pay a price for, but at the same time it provides us with a benefit. Illiquid assets are not designed like that. Contractually, they're tied. You're tying up your capital. They're not fully liquid. They're periodically liquid. They produce some cash flows over time, distributions from the fund, for example. But you can't redeem the future value of your investment today, unlike a stock or a bond. And this is a key difference. So if we are trying to redeem that value, there's vehicles and quote unquote exchanges that try to accomplish this in the secondary market. But there's a lot of regulatory restrictions to do that. And clearly, when you have a very thin market, you're bound to pay a very significant discount when you're disposing of that asset. So that's probably the action of last resort. And clearly, when we're a rational investor, when we invest in private assets, we do not consider that would be selling the asset at some point. So this value has a moot application in our framework, because this is not what we're going to do. Most likely, we plan to hold that asset until it's fully redeemed. Usually, those vehicles, private equity funds, have a lifetime of somewhere between 10 and 15 years. So it's more of a future value of the cash flows risk rather than the redemption risk, or I should say, secondary market sale risk. And in some ways, even the very exercise of planning that liquidity is in order to avert the need to sell in the secondary market, and which is a very adverse outcome, because immediately we'll be paying a discount anywhere between 20 to 40% of the net asset value of that fund. So long story short, we're interested in the volatility of the future value of the cash flows for that fund, because that is really where the return is coming from. And the way we do that is actually just a one way to do that. You have to forecast the cash flows. So there's not many, unlike there's a lot of work done in other areas, but there's very few models in the industry that forecast private asset cash flows. And we happen to have one of them. And another limitation, which is kind of almost universal, is that usually those models produce a single point estimate, an expectation over 2 quarters, 7 quarters, 22 quarters, 60 quarters. to know what kind of distribution or capital call we have from that private fund. What we do is, in addition, add this volatility around it using equity risk model. If it's a private equity, if it's a real estate fund, we use a real estate risk model. If it's a debt fund, we use a credit model. You get the idea. But the short kind of concept here is that we are projecting over period after period, we're projecting cash flows with some probability distributions around it. And using a simulative approach, we can aggregate those paths of cash flows over time and calculate the future value, the distribution of future value at any point in time in the future. So if we're interested in a horizon, which typically would be the full horizon of our portfolio, that based on the investment policy, that would be the horizon that would be making this analysis. But it has a very kind of tangible, hard element to it that we are forecasting this with a couple of models working together. And that's a good starting point, because now we know what the variance of that future value is. The next question is, what is the covariance? We're talking about minimizing the variance of a portfolio, and that means that we should have a covariance matrix of several funds. It is interesting to note, and there's a algebraic proof which kind of probably wouldn't fit on a slide, that's why I didn't put it, but we can discuss it offline. But if you take the single period data between two investments you simulate one of the investment just simply using the beta to the other investment. So if one investment has a return of, say, 3% and the beta is 1.5, you get the second investment return 3 times 1.5. And we sort of simulate the same way we did before as a standalone investment. We just simulate in this fashion the second investment. It turns out that if we take the standard deviation at any horizon, if we take the standard deviation of that, I should call it the driven volatility. So in other words, there's nothing idiosyncratic in the second investment, just that driven volatility by the first investment, and divided by the standard deviation of the standalone of the same investment. That is the correlation between the two investments. There's a proof, but the short part of it is just this. We just back it out like this. So using an approach like this, we can capture the pairwise correlations between the different funds, and we do have the variances. So we're back to the familiar world of just minimizing that, and we can incorporate the expectations and all that familiar framework. It is key to know that regardless of the nature of the funds, by necessity, at each period in time in the future, the correlations will tend to decrease. There are exceptions, but almost all cases, correlations between investments will decrease because that idiosyncratic component compounds over time. So that's kind of an extraneous comment, but in general, we're staying on track. We're talking about the covariances. We create the covariance matrix. We can optimize. We can create an efficient frontier of the funds that fit the criteria. We decide, this is kind of a convention. What funds fit the criteria should be in that portfolio that we use as a benchmark of this other asset. And this is what this exercise is all about. So once we create this efficient frontier, we pick a point. Usually it's the lowest point, and use that as a measure of return of that fund. So again, we are measuring these kind of flawed returns historically. It is the way it is, but at least now we know that what we're using as the reference there's some rigorous basis behind it. It's not just arbitrary. So the next one, and this is sort of another problem-prone approach, and there's a number of very large institutional investors on both sides of on both coasts and as well as in Canada that use this approach. It is seemingly easy. Essentially, it involves picking a public index, but we can, with some leap of faith, we can believe that it's actually has something to do with private equity, and then add some margin on top to kind of maybe reflect the differences between the qualities of private equity and public equity. As you kind of probably already get a sense, all of this is a very subjective exercise. First of all, there's a whole bunch of hedge funds claiming that they are reproducing the returns of private equity. While they're producing superior returns, which I'm not disputing, it's just the very idea that you are producing the same returns of private equity is just like, what does this mean? I mean, what is private equity? What is the return of private equity? We don't even have a clear concept what is a good benchmark for that. There's some well-established benchmarks, but they're smooth. How do you measure against it? And it's more of a marketing ploy than anything else, I think. But it just comes to show the subjectivity of the choice. What is the index that we use to say it's private equity? There's some good economic rationale to think that small cap companies do have this kind of the qualities of private companies, but not necessarily. Especially as the the nature of the private equity portfolios is changing away to some extent from buyouts and more into growth and venture capital type of investments. This kind of becomes more of a challenging assumption, or at least we have to be very clear what. And the usual suspect in this I've seen is the Russell 3000. And in many applications, it's just the segment we take away all the large cap from the Russell 3000, and those underlying companies are the index that we use to add this margin on top. So the margin can be calculated in very different ways, and there's rationalization around capital market assumptions, the liquidity premium. I've seen many different ways to do it. Something based on cap and beta, and other things. We're thinking of it in a slightly different way as part of a bigger problem, and kind of simultaneously we're going to be solving this problem as well as some other issues associated with using a private versus a private asset versus a public benchmark. And these issues essentially are that they have different periodicity of reporting. Public indices get reported every second, as opposed to private funds get reported returns every quarter. So again, we have the smoothing, and it was an immense issue with many of those public pensions in the first and second quarter of this year, when their public asset portfolio was precipitously going down, and their valuations on the private equity side was still at the end of 2019, and they saw their reported portfolio value shrinking on the public asset side, and everything else staying the same level on the private asset side, looking like these investments look great. At that point, using the same technology involved in what I'm talking about today, we actually did revalue when there was no kind of transparent pricing. We did revalue some funds to show that their value just dropped very similarly, not as much, but close to what public markets dropped. And again, we forecasted cash flow, we priced those cash flows as of that point in time, provided the general expectations of all these kinds of later forecast of recovery, like U, V, L, K is an interesting one. W is another one. So it's kind of people get really fun with different letters, but especially there are a couple of broad consensus estimates about how things are going to develop at that point in time in the future, and we're basing and anybody would be basing their valuations based on what is knowable at that time. And we saw that happen. The thing though is that while we clearly made the analysis and it was part of a similar presentation, this is not the standard industry practice. People continued, getting the same results, and they were really upset that it was obvious that private equity is not overperforming public equity by the same amount, because one is going down 30%, the other one is staying at zero, and everybody would be doubting that. So they had to acknowledge this in some ways and started looking for other ways to fix it. And again, this goes back to the very issue of smoothing. If you don't have the basis of revaluing as conditions change, and the market on the public side does this for us, but on the private asset side, there's just not that. It's not designed to work like that. So we have to have other means to ascertain it. So really, we have to resort to the same kind of valuation models. And here we propose a different approach, if you will. So let's say we forecast public index cash flows. It's pays dividend. We know what the dividend is. We know we have an estimate of the single period volatility of the dividends growth. Same for the expectation. We can project it over, say, 20 years, which is, as of today, is about the average life of a public company. It's a little less than that, but that's kind of empirical evidence from various indices. So if we project over that horizon, we apply the same kind of cash flow forecasting exercise, and we calculate that future value. We can value those cash flows today, and say this is the fair value of those cash flows. The thing though is that those indices do trade; they do have a reported price. So what can we do is just kind of infer the risk aversion embedded in the public market price. And by risk aversion, I'm still kind of a little mysterious. I'll say what we mean by that exactly on the next slide. But essentially, there's some expectation of profit, there's some expectation of loss, and there's some risk aversion to the loss, regardless how you define loss. And this is kind of really where I get picky, but we have options. So we do that on the public index side. So we can do the same thing on the private asset side. And there is one of the organizations that deal with private assets valuations and providing guidelines is the American Institute of CPAs, and the CFA Institute is another organization that has issued guidance on this side, and the International Private Equity Valuation Board as well. So these are kind of the three major organizations that deal with these issues. And pretty much, if you read their documents, they read very similar to each other. They have different focus. One is more focused on buyouts, one is more focused on companies or venture capital funds, but they generally state the same thing, that you have to find out the most recent transaction that has similar characteristics to the one that you're analyzing, and infer from it something about to calibrate your pricing model based on the most recent transaction. So this is the only thing we can do for private assets. There are two types of transactions that occur. There's a primary market transaction. In other words, an LP commits to a fund, and that's a transaction. It's essentially a futures contract that has multiple dates of paying for, and clearly the horizon is much longer, but that's what it is. So there's that transaction that we can use to infer risk aversion. The secondary transactions, people do sell funds, and there's the discount, but it is what it is. There's a price embedded in those cash flows. So we'd probably prefer the commitment one for a couple of reasons. It's widely reported. It happens quite often. There's at least 5,000 different pension plans only in the US that normally would commit to funds quite often. And these are reported transactions. We can look at them and use it as a gauge for risk aversion on the private asset side. So now we can take the private asset risk aversion and price the public index with it. Sort of take whatever this utility somebody would have from losses on the private asset side because of that illiquidity component and maybe other issues. We price the public index with it. So we get a new price for the public index, which most likely will differ from the price we get in the marketplace. When we take the percentage discount for that new price that we derived, essentially that makes sense to be the margin on top of that public index that we have to require in order to make an apples to apples comparison with the private asset benchmarking exercise. And the reason is there's the same risk aversion embedded in it. These are not the same investments. There's a whole bunch of reasons that there might be this margin, and some people claim that this is the liquidity premium. Maybe there's some part to it, but there are other possibilities as well. It's just that maybe as an asset class, and we're not making that assertion. Big disclaimer that maybe as an asset class, private equity does provide on average better returns. So we do have to, compensate for that. Whatever it is, we're sort of making sure that there's some rigorous basis of deriving that premium. So I promised before that we talk very briefly about the valuation models that we're utilizing. So there's two of them. One is kind of the homegrown breed, which is called XPLO, standing for expected profit and loss. And it's a very simple construct, which is what is the expected profit? There's a risk aversion coefficient, and there is an expected loss. There's a paper that shows that this actually has a rooting in log wealth, but it's not a story. It's kind of very long paper. Some of you have had a chance to read a draft, but clearly it's there's some rigorous basis behind coming up with this valuation. It's not just the intuition. It's might appear quite intuitive because people are not necessarily, by the nature of what they know without the quantitative knowledge, necessarily associate their aversion to losses with variance. They associate the aversion to losses with losses, and they like profit. So that's kind of a very simple explanation, but there's some math to show that actually makes sense in much more deeper level. But we also can use a mean variance approach. So what is mean variance optimal? Should price that investment in some way that makes people indifferent between investing in a risk-free investment, the certainty equivalent argument, essentially. So we can use the same kind of approach as we do for the expected loss. We caution strongly against using a single period discount rates. So in other words, discount rates are calculated using a single period risk model, like CAPM, for example. Those single period. We talked about multi-periodicity, that the betas are lower, generally speaking. And that doesn't necessarily mean that the investment should have a lower discount rate, because there's some, for private equity in particular, there's some idiosyncratic component that is undiversifiable. That is the very reason people invest in private equity. They do want to take idiosyncratic risk. They do believe that there's some superior knowledge, some operational skills that will produce superior returns. You can do this with thousands of companies. You can only do it with 50. And there you go. You have some idiosyncratic risk. You invest to get idiosyncratic risk. CAPM doesn't rely on those assumptions. So we do think that our framework is much more general in that sense and really more useful. It doesn't make this assumption and many others that are flawed, but they just use out of convenience to come up with a number. And another way to do it is essentially what you get if you're buying a house or anything else. You're just looking at market comps. So if you're investing hundreds of millions of dollars private equity fund probably want to do better than that because market comps essentially is just using somebody else's black box. You don't know what the assumptions were. You might have been wrong, but you think that this is what the market is, and the market is very thin. So it's a very bold, very trustworthy exercise just to take that number and assume that might be a multiple of EBITDA or enterprise value and whatever. It's just something that's often done, but the rationale behind it has almost become an automatic thought, and we're trying to revisit this. In some ways, our approach is also based on market comps. It just kind of elicits much more deeper level of information about the investment and what kind of the trade-off between profit and loss represents. And we can take this from the most recent transaction, which we can call a comparable transaction, which is exactly what it is, but we're just using the information in a much more rigorous way. So this is a demonstration of both models, and ironically, we can only demonstrate with such depth this in the public markets where already we have arm's length transactions, but both of them work. So we do see that the Explo model works better in general than the mean variance approach. And in particular, not for any other reason, maybe, apart from the fact that it's capturing some of that lower tail effects. But in periods like quantitative easing, mean variance actually produces, and this is the Russell 3000, by the way. So we follow the whole exercise I described, looking at dividend growth over the last 20 years, and just forecast for each month, we forecast the cash flows over the next 20 years. And we price those cash flows based on the most recent transaction, the last month's price. And we go forward in this fashion and plot the actual price in that month as opposed to what we estimate. That's what you see on the screen. So the mean variance is kind of producing negative risk aversion in periods where there's a lot of liquidity. And an intuitive explanation would be that it doesn't capture well enough the higher moments of the distribution, because those long-term distributions, if you recall the pictures from a previous slide, are strongly non-normal. And this is, they're not crazy non-normal. They're not like bimodal or anything like that, but there's certainly an aspect to them that is, variance would be missing. And especially when, kind of the quantitative easing is really incorporating a non-arm's length player, which affects prices. But risk aversion kind of gets modeled up, and only when we are looking at very small discerning type of increments which are embedded in the loss, we can capture the actual risk aversion. So bit data is made both models work, but you can as long as you can forecast the prior cash flows, you can apply both of them and pretty much get very similar results. It just one, in our opinion, is a bit better. So what we did was an entirely useless exercise apart from the fact to show that our models work, because public markets do have pricing, privates don't, and this approach has to be applied to private markets. So once we have this valuation tool at our hands, actually our hands get untied, because we can do anything. We can nowcast the values of funds. We can calculate returns on a high frequency when they get reported, and essentially calculates the returns on it's a natural desmoother, if you will. We don't need to do some sort of desmoothing technique, just looking at returns and kind of assume these are the real returns. When we do those revaluations based on current market conditions, we're naturally desmoothing the returns that we calculate for private equity, even though they get reported on each quarter. So a lot of these issues do get mitigated. It's not like a panacea for all of them, but it's definitely a big step in the right direction in our view. So the other approach, and I'm sort of probably oversimplifying here a little bit because not all of them are like that, but the public market equivalent approach has a number of varieties, and the latest one of them is the one created by Kaplan and Shore. And there are others, but the idea is kind of interesting and efficient in some way, quite ingenious. I'd just be talking about the Kaplan and Shore version. The other ones are, some other varieties. But what I particularly find attractive about the Kaplan and Shore version is that embeds the idea of performance measurement with your assumption about the benchmark. So you're doing simultaneously you don't need to assume any margin on top or anything like that. So you just pick a benchmark and you can compare different funds against that benchmark without any other assumption. So it's essentially the future value of assuming, looking, of course, in the past. So we sort of travel back in time and know the future returns of the public index, and we know the cash flows of the private fund. We compound all the cash flows that occur at different points in time to a particular period later on in the fund's life. And we do this both on the distribution side, where the funds gives back money to the investor. That's both return of and return on investment, as well as the capital cost, which is the actual investment that the investor is putting into the fund. And when you do this compounding, you're simultaneously taking out the effect of the market, if there is one in the cash flows. So, and you take a ratio of that, and this is what the PME is. It gives you a sense of, how much you get for your dollar invested, but taking away the fact that the opportunity cost that you might have invested that in the public market. So it does the calculation does this automatically. So it's a new construct. It's nothing like the typical benchmarking we're familiar from the public markets world, but it is a useful exercise and considered to be one of the more superior ones. There's something similar, which is, I'd say, probably another version of IRR, but actually it is just about that additional. So if there's a version of alpha which is IRR version, that's what it is, direct alpha. It's derived similar to the way the PME, the Kaplan and Shore PME is derived, but the math is slightly different. And it was created by three guys. One of them is an academic from UNC, and the other two gentlemen are Barry Griffiths and Rudy Stucke. I happen to know both of them, and we had a chat about this. We're pretty thrilled about what I'm going to show you next. But essentially, this is kind of the cornerstone of all benchmarking exercises. They're backward-looking exercises, and there's few data in the past. The robustness of measuring that performance is not super convincing that will continue in the future. So maybe we want to interject some of our beliefs about the future and see how that's going to impact the measurement between the forecasted performance of a private investment and that benchmark. So maybe what we want to do is really convert those different measures, like the PME, the direct alpha, into a forward-looking version. And again, with the same tool set that I showed before, it is possible to calibrate and to configure it in a way that both calculates the forward-looking PME and by just virtue of doing a very similar type of simulation. Or if you recall that exercise where we took the driven by version of the expectation. In this case, we're working with expectations and the standalone expectation. When we take this time the ratio of the standalone expectation and divide it by the driven by expectation, we can prove that this is equal to essentially the 1 plus the expected direct alpha raised to the power of number of periods of the forecast. Again, if you're interested in the proofs, I'm happy to discuss offline, but it's kind of a neat way to convert something that exists just as a pure performance measure, something that really a decision-making tool about the future. Because many times in the setting of benchmarking is about who gets a high bonus, but an asset owner should be more interested in which are the managers that I need to hire. So how do we get the same information that we do for benchmarking into an exercise where we actually make a decision based on some of the more quantitative, more rigorous metrics for funds that we can calculate. We've had different versions of these kinds of questions, and we've presented on some of them at QWAFAFEW maybe a few years back. You might recall the optimal deal flow for liquid assets. It's a very similar kind of task, just derived in slightly different means, but that's kind of just pick your weapon of choice, how you want to measure superiority. And both PME and direct alpha have some merit in that because they're based on cash flows. They're not based on the reported returns by the manager. So liability-driven benchmarking, I'm probably kind of very quickly skim over this. If anybody's interested, I'm happy to talk more about it. There was a Northfield webinar a few months ago that was specifically dedicated to this, but essentially it deals with the problem of what do I do when I have liabilities coming in? How do I optimize my public plus private portfolio to be able to meet those liabilities? And it's a much more kind of total fund question than just private equity in particular, but it's a legitimate question, and private equity has a central role in it because a week doesn't pass by when some of our clients don't ask us what is the maximum amount of private equity or liquid assets we can have in our portfolio if we have liabilities. And this is really the approach that we should take in order to answer that question. And the liability-driven benchmark is purely about the future. It's not about the past. If you have a liability and if you fractured it in the past, you'd probably be in trouble. It's kind of, you wouldn't be asking this question, or be out of business, or it's not a practically important question. What is important is what should I do today in order to avoid it in the future. And looking at those again, the same. We just lay out the steps here. Forecast using a cash flow pacing model, incorporate the uncertainty of the cash flows, this time of the overall portfolio. And the way we do it is, again, capture the covariance not only between private assets, but between private and public assets using the same approach. Do the covariance matrix. We can adjust for high moments, and because we'll be working with p-values, we're not working with variance, because each variance adjusted for high moments will have equivalent in p-value. So that's kind of a lot of the inner workings. I won't be going too much into it, but essentially, if you're looking at our portfolio and project different paths and we have certain liability in any particular period of time, we kind of pick more and more paths until we exhaust supposedly all the different possibilities. Clearly, that's impossible because you have 60 quarters and you have like a couple of thousand points on each projected. You get numerous number of combinations, even if you sample those. We found a way to do that actually to a pretty high level, to the power of 21 different paths. It's a combination of simulation and dynamic programming that accomplishes this. Effectively, that's what it captures, and we have a cost to continuous distribution. So many people would ask, like, if you kind of optimize your portfolio to produce, to be able to meet your liabilities with, say, 90% in 5 quarters or in 2 years. How do I reconcile this with another requirement that I have, another liability in maybe 6 years or 10 years? And the answer of that is simple. We can prove that if we just use optimal portfolios that work on an efficient frontier in 2 years, and we use only those portfolios that are optimal, and we use them in the subsequent optimization. But essentially, these are filtered through optimizations. Eventually, you have, if you get any solutions that actually satisfy all of them, which is a big if, but it is what it is, then such a solution will satisfy all the previous ones. Because any solution that works in 10 years will be a linear combination of solutions that worked in previous periods. There's a proof that shows that it will work. Again, welcome to discuss offline if you like. So that's pretty much kind of the talk I had in mind for today. It's kind of clearly, there's much more than benchmarking bubbling underneath, but the benchmarking is a very practical, very sensitive issue, and we can't go without mentioning it at the front lines when we're talking about these types of analytics. So I hope you kind of found this useful and enjoyed it, and I'll be happy to hear if you have any questions or comments or thoughts or criticisms.
I had a couple of questions. Can I just jump in here, or do I have to raise my hand, or?
Just jump in here.
Okay, all right. That last point, I have a whole bunch of comments, but I'll try and run them in reverse, and I won't try and take up too much time. When it looked like liquidity, that final point, it makes these things look like a bond to me. I mean, if you don't worry about anything until the final payout, I mean, that's kind of what you do when we think about a bond. So I wonder if, instead of trying to incorporate stuff from the equity market, do you think maybe just approaching them like a bond would help at all?
Well, if you recall in the very beginning of the presentation, I mentioned, I agree with you, and I think I know what you mean by that. So I'll get to that particular aspect of it, but I just want to kind of make one thing clear, that when we're talking about asset liability management, usually the first thought that comes to mind is duration matching, which is a very clear bond concept. What I would very strongly caution against is to use this in the private markets, because what the duration implies is that any period, any point in time, you are repricing. That's what duration is the sensitivity of the price.
Okay.
Repricing future cash flows, and sort of you're assuming this trade-off between current measure and future measure, and you're assuming that this is feasible. The problem is that these are private investments, and you cannot do it. It's the duration is not helpful, because it's just a wishful thinking. So even if you duration match your liabilities to your cash flows, there's two things going on. First of all, your cash flows are hugely uncertain, and second of all, you don't have that trade-off, that marketability of the future liquidity today, which the duration matching implies over time. It's a subtle kind of criticism to duration matching in the presence of private assets, but it's I think a very legitimate one. So there's no fault at just looking at the actual cash flows and the actual liquid resources available in the future and try to solve that particular problem, because it's not a proxy question, it's the actual question that they're trying to answer. And people are interested in what is the shortfall. For example, you're an insurance company and you have actuarial liabilities, your investment portfolio is supposed to fund them. If you're a pension fund, very similar. So if you're an endowment, maybe you have some other kind of expenditure goals to build to move the highway and build some sports facilities somewhere. But it's just something that nobody's liability free. Even those are liabilities that come from lifetime goals or anything. Why would be making money if we don't intend to spend them, right? So that's really kind of discretionary aspect of it is makes not a very universal problem to solve, and it's a very explicit problem. We want to maximize our long-term portfolio value for whatever reason, and at the same time we do want to meet those liabilities that we've set for ourselves or somebody else set for us. It might be kind of expenditure related, it might be contractual, like an actual loan, it might be actuarial, but it's a very well-defined problem. It's just a little more sophisticated to solve, especially over multiple periods. But we think we have a handle on it, and that's kind of encouraging.
I have to apologize. I came in late, so I missed those first couple of slides, and so that may have made things a lot clearer. There was one thing on page 13. You had those graphs of the points, and I thought it was risk and return. Is that risk and return there?
No, actually, these are these are estimated prices.
Okay, all right.
As opposed to the actual price.
All right. And the only other comment, you talked about the market comps being, you were very polite about it, but you admitted that they were important, but they're not important. We rely on the market to tell us things about all the different types of models that people might be using, and to ignore them, sort of, you run the risk of saying, I've got the right model and everybody else is wrong. So I'm always a little.
Well, we're not trying to say that.
Of course, you're Northfield, so yes, you do have the right model. So
well, but even at Northfield, we don't want to ignore reality. It's actually it's just what is the model of that you're using. So yeah. I probably should kind of more. It's a great comment, because in the future when I refer to it, I'd be referring to comps like actually the multiples, like what is sales to price or EBITDA to price. These are kind of very simplistic ways to relate. You have EBITDA, but there's a whole other set of parameters about the future of this company that leverage is one of them, and many others. So it is really at least in my mind, I mean, kind of if this pricing approach works in the world of derivatives, essentially what you're looking at, both on the Expo and the NV valuation models, they're converting the future cash flow distribution, they're converting it into the risk neutral distribution.
Okay.
But they're doing that by using a market comp. So that's kind of the.
Yeah. All right. Get back to that. Yeah. All right.
Yeah.
All right.
We're just not using a.
I look forward to reading it all.
Sure. I'll send it over. Actually, I'd appreciate if you also provide some comments.
So will you post them on the or Shri, will you post them?
So I've already sent it out to you, but I can put it in the chat window also.
I will send it out, the link to the presentation.
Yeah, so the video and the presentation, so it's been recorded, Larry. So whatever you missed, you can hear it again.
Okay, thank you.
Any other questions or comments?
I'm just a little unclear. Going back a few slides where you have the horizon-dependent distribution of outcomes, mm-hmm. Can you draw me the bridge of how you're getting from, how are these constructed? That seems to be key to your getting to the distribution of forward values.
Sure. So this is the slide that you're referring to, right?
Yes, correct. Yeah.
Okay. So let me kind of first put it in more intuitive terms and then explain what is going on behind.
Terrific. Thanks. Yep.
So,
Eric, by the way, there are a couple of guys trying to get on the court right behind you. Sorry, Mel.
Yeah, no worries. If for example today I commit to a fund and they start calling capital anywhere between today and the next 2 or 3 years, that's what usually the timeline is.
Right.
All this money gets invested, but there's pretty much no return coming from it. There's no yield from the fund or distributions.
Yep.
So you're very certain that you get almost nothing, and your expectation is low, and the uncertainty around it is low. As the fund starts to grow, and here we're talking about cumulative cash flows, because the periodic cash flows are going to look different. I actually can send you another graph, or maybe I can include it in the slides and give them to Shri and Hugh, and you'll be able to see it there. Just as a
I can add it to the slide deck when you send it to me.
It's all right. These are good for now. Can you just explain what these are?
So the more you kind of living through the funds, building up capital, investing, growing the capital, actually doing what it's supposed to do, return on investment. But while it's doing that, the big part of that return on investment is liquidation of underlying portfolio companies. So it's winding down. And it will start producing less and less uncertainty with time. It's just the uncertainty is going to stay relatively the same. The average is going to stay relatively the same, but there's going to be some incremental impact of selling the very last company in the fund, which rarely happens actually. Sometimes they just write them off. But maybe 90% of the companies will be sold. And they produce cash both as operating entities in the meanwhile, as well as at the time when they get sold.
And the periodic cash distributions are represented on the vertical axis. Is that what I meant?
Well, these are cumulative actually. This is kind of
cumulative is on the horizontal, right?
Yeah, the value.
What's on the vertical?
It's probability.
Okay.
Or I should put it as probability density if it's a continuous distribution.
Okay, it's a PDF. Okay.
Yeah. And we actually empirically derive those by first projecting the periodic distributions. Then if you take these, we take all these paths and sum up the cash flows.
Right. And
we come up with those distributions. But we're doing it in a more elegant fashion. We're not just kind of adding up. As I said, there's some dynamic programming component embedded in it. But essentially, that's what it does. I mean, we add up effectively the cash flows over many paths.
Okay, and what are the underlying assumptions that create the distributions that you had?
Well, you have to have some expectation of growth. That doesn't need to be the same growth over time. There has to be expectation of the single period volatility of the underlying portfolio. For example, if you invested in, say, 30% in technology in the US and 10% in healthcare in Canada and industrial, the rest is industrial in Mexico. These kinds of this type of portfolio in a single period risk model sense will have some volatility associated with it. So we take this volatility and we put it behind. So there's a single period volatility that compounds over time using that simulation, which takes the single period. Even it might both the volatility and the expectation in a single period might be varying over time as we project it. And
so each of those graphs is a simulation of a point estimate of single period volatility and empirical. Does empiricism influence those graphs?
To the extent that it's embedded in the expectation for growth and the risk model that you're building to come up with the volatility. Yes, you can just take the historical volatility, which you have to you have a single company that's publicly traded, maybe that's a good idea. But if you have a portfolio, which is usually the case. For example, if you're co-investing, it's very easy because even if it's a public traded entity, you see what the volatility looks like. And you're taking it private in a co-investment, so it's a single company, a portfolio of companies. You're not taking over a portfolio of companies. You're just taking one company. And in those cases, it's easy just to see the empirical volatility. But for something that is a portfolio, then you need the interaction effects, and that's a very intuitive way to do this with the risk model. So that's, I don't know if this answers your question, but
it's just a little unclear to me what the bridge is between the estimate of the benchmarks properties and the estimate of the forward valuation outcomes that you had on slide, what was it, 16?
Well,
and I think that it's based on those distributions that you were showing on slide 8, but I'm a little unclear on what the bridge is from A to B.
Yeah, I understand, and it's actually not a kind of chronological relationship, if you will. It's more of those forecast distributions of cash flows of a fund. They're used for multiple different purposes. In the very first case, when we have the private-to-private benchmarking, we're only using them to come up with the covariance of funds to be able to do optimization and create a minimum variance portfolio. Then in the—
Can I stick in a comment here, guys?
Sure.
Yeah, go ahead.
What I think is key that is different about public investing and private investing, and I think that may resolve Eric's question, is that in a public investment, the investor decides when money goes in and when money comes out. If I'm an investor in a mutual fund, I decide when to put money in, I decide when to take money out. In a private equity fund, what is typical is the investor signs up for a total investment, say $100 million, and the private equity manager, the general partner, says, okay, I want 25 million now, 25 million in 6 months, 10 million the 6 months after that, and so on. They set the schedule of when money is to be invested.
Yep.
Similarly, the general partner of the fund decides, oh, when should we sell the private ownership of some company in which we have invested? And that will be at the discretion of the general partner, typically over a range of 5 to 10 years from when the partnership was initiated. So I think what you're seeing on the screen, the slide with these paths, really has to do with 3 things. One, what is the schedule of when money has to come in, which is dictated by the general partner? The returns that are achieved by the companies in which you've invested, which is hopefully, successful, but may not be. And that potential for not success or large success is a function of the risk of the portfolio, which we evaluate in a separate way. And then the third question is, okay, we've got all these shares of private companies. When do we liquidate those and turn those back into cash and return the cash to the investors? What is different here is that when a mutual fund sells public shares, they just take the cash and reinvest in something else. In private equity, when an investment is liquidated, whatever the cash proceeds of that liquidation are, that money goes back to the investors. It does not go into a new investment in something else. And so you've got this distribution of the expected distribution of future outward cash flows back to the investors. And those outward cash flows are a function of two things. One is the distribution of returns you expect to get, like, do I expect to get a 2% return or a 10% return? And the other is the timing of, am I going to get cash in 5 years, 6 years, or 20 years? And so I think what shows up on slide, I think it's 13, is the distribution of, no, keep going.
6 or something. Yeah.
Back.
Yeah.
Slide 6 is the distribution of the cumulative net cash flows. So how much money has come out and when?
Yeah, it effectively, I mean, it takes some imagination to kind of see that, but maybe if we had more of those distributions positioned differently and kind of put side to side, you'd see the so-called J curve in the which is usually depicted in private assets. But usually it's depicted as just one curve, but you have a distribution around it. Essentially, that's what it's going to look like over time.
Money goes in, and some years later, money comes out.
Mm-hmm.
Right.
And the cumulative value of money in and money out is what you're observing at different points in the timeline.
Right.
Yep.
And the transform from your private equity investment using some function of either a publicly available benchmark or some kind of assumed mean variance function is what drives the shape of that distribution. It's just not clear to me what the assumptions are for the transform for that function.
Well, you've got mean, you've got variance, but you also have the timing of the cash flows.
Yep.
How much comes out in year 5? How much comes out in year 6? How
Right.
much comes out in year 10 or 15?
Right. And autocorrelation and intra-investment correlation, right?
Well, autocorrelation is going to show up just in the sort of titular returns. It's
It'll be
what
dependent on path
numbers
of
show
interest
up.
rates and things like that too, right?
Well,
Right.
Yeah.
absolutely. It kind of effectively captures the independence of the returns of the, say, analogous public portfolio for a single period, for any particular period in time, and the cash flow. So we start with this expectation of cash flows over time. So there's no correlation, no variance. You might have heard about the Takahashi and Alexander model, also known as the Yale model, which is the first cash flow forecasting model, which says, like, in 5 years, what they expect for a buyout fund to be the distribution rate out of NAV. So our model is more advanced version of the Takahashi and Alexander model, but the TA model and any kind of derivative thereof is an expectation model. So it's just a point estimate. What we incorporate behind the curtains is saying, if this public portfolio is, is a return of X. I put it in simplistic terms. There's more behind it, but
yeah.
So if the average of that portfolio is X and my volatility tell me is X plus 5, how much the private portfolio, based on the same information but maybe higher growth, it will have the same kind of ratio of performance as opposed to the average. So we kind of spin out this periodic cash flow distribution. Yeah. We're still talking about periodic cash flows. So then you start, once we have like 60 quarters of periodic cash flows, we simulate, say, 10,000 different points on each. And we start, clearly when you have earlier periods, you're clearly very robust. You have less points. The more further out you go, the more points you have to sample. But either way, it doesn't really affect the fact that when you start adding up cash flows point by point and kind of create all the different permutation, which is some astronomical number, and infinite if you're taking a continuous distribution apparently, is that you're going to get some distribution of and taking account of the probabilities as you go along the way. You come up with distribution of the cumulative net cash flows of the fund. Yep. So in the earlier periods, because you're paying more than you're getting on average, you kind of get that J curve effect, so that and the J curve is going to open up as far out you go because you have more uncertainty, and that's exactly what this is representing. As Dan mentioned, the very autocorrelation comes out by the fact that cash flows, you have this very strong time dependency on the return. So there's definitely some the returns are not going to be, the cash flows are not going to be independent over time. So you get that aspect of normality. But
you're kind of assuming stationarity of autocorrelation and of, let's say inter-period.
To the extent that you expect a public portfolio of similar companies, because this is what we're using as a reference for the volatility. Yep. As long as you assume that the returns are independent period after period, we're still good.
That's crazy though, that they're not.
Well, it's
that autocorrelation is extremely unstable. If you end up with a huge move in interest rates one way or the other, you're going to have autocorrelation one way or the other. And you will.
Well, let me put it like this. So these kinds of vehicles usually operate through at least 2 full cycles of the economy. So you'd see all kinds of regimes that they go through. It might.
There's been one predominating regime for the last 40 years.
Well, I don't know how long it's going to persist, but
presumably with interest rates at negative something, not too much longer.
Right. There's some autocorrelation, but I guess the key part is in returns. But the key part is, if you're able to predict them, apparently that's a very profitable proposition.
I get it's unobservable, but given the data that we have, but it just seems like that's
it dissipates quite quickly, I think, at least in my observation. It's not a persistent phenomenon over time, and it goes in different directions. That's what makes it very risky proposition itself.
Sure.
So clearly, we don't incorporate every possible type of distributional work that we can think of, but it is possible to be incorporated. We just haven't done it in this month. We can do that, and the basis of kind of the very simulative type of approach rather than just a pure parametric approach is possible to do that. And I just want, because you also mentioned it's stationary. Actually, it's not stationary because you can assume that the volatility is going to change over time. If you recall, I mentioned the different kind of the U-shaped recovery, the V-shaped recovery. When we were forecasting those, we can change both what we did at that particular point in time is we looked at, and this was back in April of this year, we looked at the global financial crisis and we looked how the, what we call at Northfield, the short horizon models. So how the volatility of the short horizon models changed over time and evolved. So we incorporated the same kind of pattern going forward. And we also took the growth of the economy and kind of as with some kind of relationship to growth of private equity in particular, in terms of some kind of long-term beta. We take those into consideration, but the very fact that we're talking about U-shaped recovery, V-shaped recovery, means that the single period returns of those periodic distributions will change over time as well. So it is definitely not stationary. It can be very easily made non-stationary. On the return side, on the cash flow side, is pure non-stationary because you have different timing of cash flows, and it is very different for buyouts. It's like 3 to 5 year holding period. For venture capital fund, it's like 7-10 years, maybe. Growth companies, now we're talking about evergreen funds that invest in companies just like mutual funds, and there's some like funds that have undefined period of time they're going to hold underlying companies. It's like a cash flow vehicle. So distribution speed is driven by two things, like how fast the company grows and its yield, and at the same time, how much of the company is getting liquidated. So you get much more cash flow, like with if you're looking at the venture capital fund, because it is liquidating much later to be able to grow the companies. And it depends on, I mean, that like early stage, late stage, as growth, it has different holding periods, but essentially if you're thinking about one long-term projection of a venture capital fund, it will generally be much more, all the distributions will be at the tail end of the fund life, because they need to develop those companies, and many of them will probably just be sold as kind of not very prosperous, and they'll prefer to have the cash to invest in companies that actually they've seen work, and those companies will grow, and they need some runway to develop. But clearly every type of private fund, like real estate funds, the funds that are opportunistic, buy some properties and just overhaul and then sell them, just like a buyout fund. And there are others that invest for the long run. They're just like a fixed income instrument, where the distribution speed is almost the same for the fund's life. It's just this probably better risk return characteristics, or at least that's what the manager would want to show. But it's a much more different type of speeds, distribution rates over time, and this will have an impact of these graphs that you see on the screen, how they evolve over time. Will also change with the type of funds, not only with the variance and expectation and all the different kinds of distributional shocks that we can, or parameters that we can incorporate period by period, but also by the fact that the distribution speeds change. If they accelerate, the fund will deplete much faster. If they accelerate, if they accelerate, it will deplete much faster. If they're slower, clearly you can hold it for much longer. And evergreen funds that actually never get depleted. So then this distribution just grows over time. The uncertainty around it grows over time.
I get it. Yep.
All right. So maybe with this discussion, we covered any questions that's.
We have a question in the chat.
Okay.
I have another question here in the chat here.
Here's some question. Can you just so fine?
I can read it out. Which correlation or beta between public and the private equities do you typically get using this approach? It's from Michael Mallinger David.
Yeah, the correlation generally is high. The kind of the numbers we get are higher than normally you would see using smoothed returns. In this, I'm just comparing it to a technique that's generally been discussed in the literature. So we're seeing probably correlations somewhere between, and again, this is kind of a risky proposition to paint things with a broad brush, but if we're seeing correlation anywhere between 60 to 80%, and these correlations decrease over time. So if we're talking just about a single period, they'll be very high. If we're talking about maybe 0.8, if we're talking about 5 years, the correlation will decrease because of the idiosyncratic component. And just I wanted to kind of echo the prior comment that private investments are meant to be idiosyncratic. That's what they kind of feed on idiosyncratic behavior. And they cannot be focused on many companies at the same time. So this idiosyncratic component will accelerate all the time. And I think just, again, painting things with a broad brush is not the best idea, because when we're talking about a particular portfolio of private equity funds, it is a very different type of behavior than, say, the Cambridge Associates Index or the State Street Private Equity Index or the Burgess Index or whatever. And the reason is those indices are very broad. There's much less idiosyncratic behavior. But us as an investor, we cannot. I mean, these are lump sum investments, and they invest in lump sum companies. So even if we try, we cannot get the same diversification we get with, an index like the S&P 500, Russell 3000, whatever. It's just the nature of those underlying investments that is idiosyncratic, hard to diversify. And for us as an investor with limited resources, we just can't get that many of those items to diversify away. But if you're creating a benchmark, we have unlimited capacity to add stuff. So we can get all the investments we have data of, and you put them together, and you get a behavior that no single portfolio exhibits and can never exhibit, because it does not have the capacity to get to that level of diversification. That's why when we're talking about the asset class correlation with public and privates, it's a very kind of floating question, because do we call the asset class to be the very broad benchmark, or do we call it to be our portfolio? Even if we are a large asset owner, it's still going to have some capacity constraints, which the vendors of private equity benchmarks don't have. It's all data to them. They construct it and you measure against it. So you're disadvantaged by construction, and that's kind of one of the nuances that we have to be asking ourselves. But without making the question more complicated than it is, I think probably it's fair to say it's somewhere between 0.6, 0.8 correlations between public and private. And it depends, kind of buyouts, venture capital growth. But that's kind of the general picture.
So Emilian, we have our first question on LinkedIn Live. So we're streaming on LinkedIn Live, and we have our first question, I guess, in QWAFAFEW. What methodology do you think would you look at to accurately value the price of an asset in the low volume, high volatile specialty market, for example, alternative currencies or crypto assets? And that's from Alexander Bukowski from New York.
Yeah, that's a tough one. Well, again, I'll probably hide behind the very concept of the market comps. If we can project, and we have some kind of past history of volatility of the crypto markets, you could say that, for example, and some expectation, as wacky as it is. Clearly, if we're an investor that have certain expectations about the market, we have some views that we can incorporate. And the framework that I outlined is very open to incorporate these kinds of views, both on the volatility side and the expectation side. So the only piece you'll be missing then is the risk aversion. And it's a relatively liquid market. It's definitely more liquid than for private funds. You get, like, during the first 2 quarters of this year, there was close to zero secondary transactions for private funds, private equity funds. In the meantime, a lot of Bitcoin and other crypto assets change hands. So we do have the basis to find out what the latest risk aversion is. And when you incorporate your own views about the asset, then you can value it, and this will be the fair value based on your expectations, and it compares to anybody else's. It's not the price that you're going to meet at the market. It's actually something like might be an opportunity to find alpha. If you will. I've never tried to do that. Frankly, I'm kind of improvising here, but it makes sense to me. And just looking at the possibilities to incorporate the type of inputs that we just kind of described in detail. All of these assets do exhibit the same types of metrics. They are not the same as with equities and fixed income and private equity, but they do exhibit, they have these parameters, and we can just plug them in and see what we get. Whether that number makes sense to other people than us, it's a very subjective, discussion. But if we are kind of put in a position to apply the same approach to crypto assets in particular, that's probably what I would do. First place I would go to.
Cool. Thank you.
Yeah, great questions. Actually, I didn't expect so many questions, but it's good.
And any other questions? Well, I want to thank Emilian and Shri for setting up this Zoom call.
Yeah, thank you, folks, for attending, and once again, I hope you found this useful. I'd encourage you to you can email me. Sorry.
Emilian, if you had any additions, please do let me know. I can append the slides. And also, if you have any code or anything you want to share, let me know. I can upload that too.